IJH and IJR are both ETFs from iShares that focus on U.S. companies, but they target different segments of the stock market. Understanding how they differ can help investors choose the one that fits their strategy best. Let's start with IJH, which stands for the iShares Core S&P Midcap ETF. This fund tracks the performance of the S&P Midcap 400 Index, which includes 400 mid-sized U.S. companies. These firms are larger than small-cap companies, but smaller than the giants found in large-cap indexes like the S&P 500. Mid-cap companies tend to be more established than small caps, offering a balance between growth and stability. IJH provides exposure to sectors like industrials, financials, and consumer discretionary. It's often seen as a core holding for investors looking to diversify beyond just large-cap stocks. Now let's talk about IJR, the iShares Core S&P Small Cap ETF. This fund tracks the S&P Small Cap 600 Index, which covers 600 small-sized U.S. companies. These companies are typically younger and have more room for growth, but they also come with more volatility and risk. IJR focuses heavily on sectors like industrials, healthcare, and technology. Because small caps are more sensitive to economic shifts, IJR can see sharper gains during economic recoveries, but may also face bigger losses during downturns. Now let's compare them directly. First, size and growth potential. IJH targets mid-cap companies that offer steady growth with moderate risk. IJR targets small-cap companies, which can grow faster but are more volatile. If you want faster growth and can handle risk, IJR might appeal to you. If you prefer stability with some growth, IJH is likely the better fit. Next, sector exposure. Both ETFs have some overlap in sectors like industrials and consumer discretionary, but IJR leans more into emerging and high-growth sectors like tech and healthcare. IJH is more balanced across the board, which helps it hold up better during market volatility. If you want broader diversification, IJH wins. Let's look at historical performance. IJR has outperformed in certain bullish market phases thanks to the explosive growth of small caps, but it has also seen sharper declines during market drops. IJH usually performs more consistently, making it a reliable long-term investment. If you want smoother returns, IJH is the safer option. Now we'll consider risk. IJR carries higher risk due to the unpredictability of small-cap stocks. These companies often have less cash flow and are more vulnerable to economic shifts. IJH companies are more mature, often with more resources to weather downturns. If minimizing risk is important to you, IJH offers more peace of mind. Finally, let's talk about cost and accessibility. Both ETFs are low-cost with similar expense ratios, making them ideal for cost-conscious investors. They're also highly liquid, meaning they're easy to buy and sell. From a fee standpoint, it's a tie. So which one is the better choice? If you're looking for aggressive growth and are comfortable with higher risk, IJR could be the way to go. But if you want a more balanced approach with steadier returns and lower volatility, IJH is the smarter pick. The best choice depends on your personal risk tolerance and investment goals.